I have a question. Chuck, what do you think about a thing that's always confused me is share price growth versus real economic growth. And it seems to me like every time I look at that, there's a disconnect between the growth in the price of some shares and the real economic value. Like the price earnings ratio on corporations, it varies so wildly. What are your thoughts on that?
Well, I think it's hugely important that you track what's happening on a per share basis, because in the last 20 or 30 years, many businesses have tried to, let's just say, pull the wool over investors' eyes by having a dilution in the form of 2 or 3% a year by virtue of stock options, and hoping that investors won't notice. But we can tell from the arithmetic that we did a while ago that 1% or 2% over a long period of time really adds up to a lot of money, and it's a taking of your economic interest. So it's important to look at both numbers, both the rate at which economic growth is occurring in the overall business and the rate at which it's growing on a per share basis, which is different from simply the price movement of shares. We try very hard not to be speculators in the price movement of shares. That is, we try to understand the businesses we invest in, figure out what their value, what their expected rate of growth is going to be over the next 5 or 10 years, not next year, 5 or 10 years, and make a judgment about the valuation of that in the market at the time we're interested in what to do. So in this period of time that we've been through, the downturn from February 19th to March 23rd, 33 days, I think, something like that, peak to trough compares to 73, 74, 2000 and 2002, 08 and 09, 07, 08 and 09, where those declines, peak to trough, took 28 to 33 months. So we've never experienced anything like this where the declines came that fast. We actually had a fair amount of capital on hand. We put capital to work, particularly at as close to the bottom as we could. No one ever gets the bottom or the top perfectly correct, but we determined what the valuations were. And when securities sold below those, we started putting money to work. We've pulled back now because it's run back up, and we were very choosy about where we put money to work, but we do it on the basis of those kinds of calculations. At what rate do we think the business is likely to grow its economic value per share over the next 5 or 10 years, and what's the right price to pay for it? Mm-hmm. And if you remember, your alternative, the 30-year bond is 1.4%, the 10-year bond is 1.2%. Those are what your choices are when you're thinking about what you might be able to get in an investment. So if you bought an investment that was selling at 20 times earnings, that's really a 5% yield on that money. The inverse of the PE ratio is the earnings yield. So 5% expected on average over a period of time versus 1.2 or 1.4%. Well, that's still pretty attractive, isn't it? Does that help, Andrew?
It does. Thanks.
So there's a couple questions in the chat room. Paul Larner reminds me that we talked about earlier, compound interest from Einstein. Compound interest is the most powerful force in the universe. Said another way, the most interesting thing in mathematics. It's not clear exactly what it was, but that was the idea. Here's another question from Carol about how did I get started in the business? So I was a pre-med student in college and then an English major. And when I got into the business in the summer of 1968, I was what I call a know-nothing. And I worked for a firm in Washington, D.C. that was financially very sound, and it was not terribly well prepared for the changes that were going on in the investment world into the early 70s. And so it allowed me to kind of follow my own nose and started my career thinking about what makes a good investment and what makes a good investor. And so that's what I did. And so I would say that it's much harder to do that today, but the most important thing is that you be curious and in what you do, and read, and then read some more. Then do you recommend low-cost ETFs like Vanguard or VTI, BOO or VTI in picking individual companies? And I would say that we have at our firm spent some time trying to understand precisely what the risks might be in the ETF market. And what we discover is that there are a group of firms that trade very large pools of capital that underlay the ETFs. The ETFs do not at any point in time have to actually reflect the value of the underlying securities. And oftentimes they do not. And in periods of illiquidity, you're betting that those firms are able to stand up and make these massive trades when presented with the requirement to do so. It is in fact not a requirement, it is an assumption. So we are in a huge minority. We don't use ETFs. We think the simple index funds are a little better than, and the cost to own them in the long run is really de minimis. But I'm not opposed to using ETFs. I'm just saying it reminds me a little bit of what we had 30 years ago called portfolio insurance. And what happened with them was that as the stocks ticked down, it triggered more sales. And I think the same is a possibility in ETFs. But the idea of having some instrument which mimics the market is a perfectly reasonable idea. Then here's another question. It says, my audio does not work. And so whatever you say has no bearing on my investment.
No, he's asking, he said, my question, stop. My question is, are there particular asset classes you like today? That is from Mr. Lerner.
Well, so the answer is our attention is focused on common stocks and that's what we invest in. And you know, personally, I do a few other things, but those are sort of a more hobby investment. My serious money is invested in these vehicles in the market.